How do interest rates actually work? Let's break it down. Easy whole number, $100,000. Okay, this is how much you borrowed. At 5% interest means you're paying whoever you're borrowing the money from, let's just say a bank, 5% to borrow money that you do not have. Let's say it was a truck that you needed to buy. You don't have $100,000, so essentially it takes money to borrow money. No one's going to lend you $100,000 for free. All right, so $100,000 at 5% equals this in an equation. 100,000 times 5%. 5% in decimal point is 0.05. That's $5,000. In year one, you're paying whoever you're borrowing the money from for $5,000. $5,000 divided by 1 year or 12 months equals roughly $417 per month. But also with interest, if you don't pay something towards the principal, you're just going to be paying interest, and that number will never go down. Obviously, you do not want to have a loan forever, so you make a bigger payment, let's say $700 per month, while $417 of that goes towards interest, right? The other $300 or whatever amount goes towards principal. Let's just hypothetically say how it maths out is that after year one, you end up paying it down to $95,000. So now your principal amount has reduced to $95,000. That means, by the way, the interest rate does not change, right? 5%, 95,000 times 5% equals 4,750. So that means now in year two, you are paying the bank $4,750. You divide that by 12. Now every single month, instead of $417, you're paying $396. So you can roughly say that there has been a $21 switch. So now $21 doesn't go towards interest, it goes more towards principal. Here's a basic drawing as to how principal and interest payments work, right? At the beginning of a loan, majority of it will go towards interest. Then a small portion goes towards principal. Over time, however, that starts to switch and the principal amount gets bigger and bigger, and near the end, interest gets smaller and smaller. At the end of the loan, the interest payment will be the smaller sliver, while the principal is the bigger chunk. So here's a really quick example, real life example. Let's say that you made a monthly payment that was due on November 5th. What you can do to drive that principal lower faster is make an additional payment, and you tell your lender, make this payment, extra payment, after what was required, direct to principal. That means, let's say you added another $500 payment on top of what you already paid. On November 6th, that would drive your principal down directly. That extra payment would not go towards interest, but it would go directly to principal. That's how you drive this number down faster. And the faster you drive that number down, the less and less that you have to pay in interest.